And we're back. We have here Mr. Efren Cruz, who's an expert in personal finance and investments. Efren, hey, big question. How do you really make money out of pool funds?
Well, it's like when you're actually investing in the stock market, you need to compare your buying price versus your selling price. So
You still follow the buy low, sell high?
that is the idea, but actually it's very difficult to buy at the lowest point and sell at the highest point. So the peso cost averaging way is the best way.
Again, you mentioned, what is peso cost? I always hear that, I always read that.
Yeah.
What do you mean by peso cost averaging? And I know a lot of the pool funds are using this as a way to attract people to invest.
Simply put, don't try to do something that is impossible, which is trying to sell at the highest point or buy at the lowest point.
Unless you have a crystal ball.
Yeah, because the only way you know that it's the lowest point, for example, is the next day. So you see, the price today is higher than the price yesterday. So the best way is actually to just invest a fixed amount every month. It's up to you, 5,000, 10,000, 1,000, even 500 now. And then just focus on certain asset that you're going to buy. For example, a mutual fund or unit investment trust fund. If the price of that fund goes down, your fixed investment will allow you to buy more of that fund. Yeah. If the price goes up, obviously it's more expensive, you buy less. But we've shown that over the years, if you follow that practice, you don't need, your average cost will be a lot better than if you were just trying to sort of time the market. And you'll have more hair because there'll be less hair pulling.
So you don't recommend people who like to time the market?
No, because time in the market is more important than timing the market.
You never know.
Yeah, you never know. Yeah.
Question. Peso cost average is working under the assumption that the funds or the investments will go up in the future.
Well, that's the general assumption.
What if the market goes down? Then the average also might go down?
Well, yeah, your average buying price goes down, but eventually, if you choose your funds properly, okay, and you actually diversify, chances are you'll end up a winner. You have eventually in the future, maybe 5, 10 years from now, you'll end up having more returns for the money that you'd invested.
I've read somewhere that mutual funds, UITM, even variable life insurance, it's not for the short-term investors. Is that true?
Yes, it's never. They're never for the short term. Primarily because the instruments that they invest in, the underlying investments, are also not short-term instruments. Generally speaking, if you're talking about mutual funds or unit investment trust fund, and even VUL, they would invest in long-term instruments. We're excluding, of course, the money market funds, which actually invest just short-term. But all the rest, they're long-term. So you cannot also do short-term trading with mutual funds.
A lot of questions. How long is long?
How long is long? Maybe 5 years or longer.
So you're saying that when you go into these funds, you should have at least a 5-year horizon?
Yes. 5-year time.
Maybe even longer, let's say for VULs.
Well, actually, before we recommend people to buy these pool funds, we actually ask them, what are you investing for? And that will actually help determine whether you are actually going to go into mutual funds or pool funds, or just go into the time deposit money market thing. You have to figure out first what is the life event you're investing for. You're sending your child to college, you're preparing to buy a house, retirement, that sort of stuff.
Oh wow, very good information from Mr. Efren. When we get back, we're going to talk to you about what kind of funds are there available, and let's try to pick the brains of Mr. Efren Cruz to find out which one is really for you. And we're back. We're having a one-on-one with Mr. Efren Cruz, the expert. A lot of people are asking, ano ba? What kinds of mutual funds or UITFs are there?
Okay, these pool funds will actually just follow the different, so shall we say, investment asset classes there are. The basic three would be money market, which are the short-term investments. The 1 year.
Time deposits.
Yep, the maturities would be 1 year or less. I'm talking about the underlying.
Yeah, okay.
And then you have the bonds, and then you have stocks.
They call the bonds, they also call it the fixed income.
Fixed income, that's correct. The bonds will be fixed income instruments which will actually have a maturity of more than 1 year and longer. In the Philippines, the longest would be the 25-year treasury bonds. and then you have the stocks. Okay. Now there can be a combination of the three or two of them. That would be called, for example, a balanced fund if it's between a stock and a bond investment. But in any mutual fund, you can actually have a combination of the three as they operate their portfolio.
Efren, if I'm investing on a short term, should I go for the money market funds?
Yes.
Or
If it's just
long term?
well, if it's just short term, yeah, go for the money market fund. That should be better for you. Or you can also invest directly if you want.
Yeah, just buy it yourself.
Buy it yourself.
Okay, another question is, there's bonds or fixed income and there's equities.
Yeah.
What kind of an investor should be investing, say, in a bond fund, or for what purpose? Or should it be an equity or combination?
Okay. If you look at the long-term return of equity mutual fund, they are averaging something like 14%. Okay. Now, if what you need to earn is something like 14% and you're willing to take the risk with the 14% potential return, you go with an equity fund. That assumes that you don't have that much money and you have to really make your money grow. If you have a certain level of money.
So when I'm young, let's say I'm young, I'm starting, I'm looking for, say, my child is a newborn, looking for college, which is about 16, 17. That would be an ideal.
Yeah, because when you're young, you don't have that much money yet, but you have a long-term horizon, so that equity mutual fund will be perfect for you.
And they always say when you're young, you still have enough time to recover.
Yeah, if you incur a loss, that's fine because you still have enough time to recover. But at the same time, you also have enough time to do the peso cost averaging. The other one is if you don't need that much money, not much return, you can actually go for the bond funds.
For more. So if I'm a little bit on the conservative side.
Conservative, at the same time, you do have this significant amount of money that you don't need to earn a lot on that money. Then you can go with the bond funds.
So if I have more money, I probably should stay with more conservative.
Yeah. So normally, but it's not always the rule. The older you are, the more you're into the fixed income investment.
So can I move? Let's say I invested in equity. Let's say I'm 25 today, and right now I was 45. I wanna move it to. Can I do that?
Yeah. Yeah. You can shift.
Can I change it along the way?
Yeah. You have to have a review of your portfolio.
How often should you review?
At least once a year. If you are starting out, perhaps even every quarter. Okay. Until you get a hang of it, so that you can see whether you are already meeting your goal and you have to slow down a bit, or if you are still way off, then you have to accelerate your investment.
I noticed that some of the funds go up and go down. When they go down, should I pull out my money?
No, that's the worst time to pull out your money. You should pull out your money when you're making money, not when it's down.
Okay.
Not
unless I should stay. What should I do? Panic?
Well, no, that's the last thing you should do. Not unless there's something fundamentally wrong with what you bought, with the mutual fund or the UITF you bought. No. But otherwise, stay there. In fact, if you have excess money, put in more money. That will actually ensure that you can earn more and recover faster.
Yeah, I noticed that when the market goes down, a lot of people are saying to buy more.
Yes.
You said to recover your losses?
Yeah, to accelerate the recovery of your funds.
Wow. Okay. That's a good idea.
Yeah, to accelerate. Of course, it takes a lot of guts to do that.
Yeah. It's normally when it's down, nobody wants to do it.
Yeah, but that's the time you really have to look into it and say, wow, this is an excellent opportunity. One of the taipans in the Philippines does that. I plotted how many malls he'd opened versus the GNP.
So we know who that is.
Yeah, of course, you know who that is. But at the start, he would always invest open malls when the GNP was going down.
What's that sound?
Because it's cheaper to buy, it's cheaper to construct.
It's bargain. It's a bargain.
Bargain. Real estate is a bargain, labor is a bargain, but raw materials are a bargain.
So when the economy recovers, they're ready. It's like the market. The economy is ready already.
Exactly.
Wow, it's nice wisdom, financial wisdom from the expert, Mr. Efren Cruz. Well, when we get back, we're going to talk to you about what's the next step, what should you do, how to start, and how to get about investing in pooled funds.